Good morning, friends. Today, on 18th of June, early morning, I'm recording this video. This is the third video in our fortnightly video series. Just like in our fortnightly webinar, I will start with the international events and how global markets have behaved over the last fortnight. Then, I will invite my colleague Vinay to share market view from technical perspective. After that, Nandish will share his readings from derivative markets. In the end, we will discuss the way forward. What should you do now? What are the stocks that can be accumulated? We have released a strategy note on how to navigate volatile markets. We'll discuss that. So now let's directly jump into the performance of global markets. So let's look at the international events over the last fortnight. The Federal Reserve, in one of the most aggressive rate hikes since 1994, raised the recession fears and sent stocks sharply lower for a second consecutive week. They were talking about 50 basis point rise, but they eventually had to do 75 basis points, and that has raised fears. The not only US but Swiss National Bank also unexpectedly raised interest rates for the first time in 15 years. The Bank of England also raised the interest rates by 25 basis points. The ECB, the governing council, also had to schedule a meeting which was not earlier decided and had to calm the markets by coming out and saying that they will do whatever it takes to help the heavily indebted members. The S&P 500 index recorded the worst weekly decline since March 2020 and entered into a bear market territory. Now it is almost 24% from its January peak. The inflation and rate hike fears also pushed the benchmark 10-year Treasury note above 3.49% on Tuesday. So this is the highest level in more than a decade. So let's look at the international markets. So as you can see from the screen, the Dow Jones, S&P and Nasdaq has declined by almost 10% over the last fortnight. Other international markets have also gone down. Hong Kong and Chinese markets which had fallen earlier now are stabilizing. Similarly, Indian markets, as you can see from the screen, has gone down by about 7 to 8%. The small cap index has gone down much by 8.5%. So market across the world have gone down. So let's look at the Indian sector performance. Metals are the worst performer. They have gone down by almost 12% over the last four. Let's look at the international events calendar. So on Monday, US markets are closed. On 29th of June, we will have US GDP data, and on 30th, we have UK GDP data. So 29th and 30th are two important events. Let's look at the two most important variables for the inflation and international markets. The first is the crude oil. So crude oil, as we can see from the charts, have corrected a little bit from 125 to 113. Still, it is highly elevated levels. For our markets to do well, it should come down to 100 or 105. Otherwise, we will continue to have the inflation problem across the world. So keep an eye on how crude oil is behaving. The Friday's fall is a welcome sign that may give some relief really to international markets. Let's look at the S&P 500 charts. So as I pointed out in my last video, this was the level around 3830, which was the 20% mark from the early peak of January, and that was the bear market territory. And US markets have broken that level and entered into a bear market territory. Now, I will invite my colleague Vinay to share his views from technical perspective. Over to you, Vinay.
Hello friends, I am Vinay Rajani from HDFC Securities. I am going to take you through the technical developments on Indian equity markets. So let us directly jump to the slides. So friends, this is a nifty daily chart. Now we can see over here that this is a trend line, upward sloping trend line adjoining the previous low. The breakdown was below the 15,750. We broke down below that level and fell significantly. Now this is a yesterday's candle, the Friday's candle, which is a doji candlestick pattern, which indicates the indecision, and we can see some pullback rally from here on the basis of this. Now RSI is also into a oversold zone which can give some pullback to the Nifty. In the history we saw that in the month of May and in the month of March, when Nifty RSI was into oversold zone, we saw a significant jump or pullback rallies. So this time also on the basis of doji and the RSI oversold levels, we can expect a pullback in the Nifty. Friends, this is a Nifty small cap index chart. Last video was done on 4th June 2022. At that time, we clearly suggested that we should remain cautious for the Nifty small cap stocks because it had made a clear cut bearish engulfing pattern on 4th June closing basis. So this was the level around 9200 when we indicated that we should remain alert about the small cap stocks. From that level, we have already seen a 12% correction towards the Friday's low. And if you were to see the overall picture, Nifty small cap index has fallen more than 32% from year 2022 high. So a significant fall we have seen recently. Now RSI on the Nifty small cap index has also reached the oversold zone. Not only the oversold zone, but it has almost made a positive divergence. So positive divergence indicates the chances of pullback rally in the short term. Overall trend is still down, but yes, on the basis of positive divergence, and this is also a trend line support which is coming around the Friday's low. So combining all these technical development of the short term charts, we can expect a small cap stocks to also give bounce back. And up to what level small cap index can bounce back? So according to us, the 8800 to 9000 is a level for Nifty small cap index where unfilled gap is there. That gap can be filled in the short term. So in next 1 or 2 weeks, Nifty small cap can give a bounce back till that level. However, the positional trend will remain down only. So friends, one of the breadth indicators that we have been tracking is the number of stocks above 200 DMA. So we have been tracking this for the NSE 500. Now this is a horizontal line over here in the bottom chart, that this horizontal line indicates the oversold level. So this oversold level is the 13% odd level, and current number is 15%. So we at present 85% of the stocks out of NSE 500 are below their 200 days moving average, and oversold level is placed around the 87 to 88%. So in history we saw a nice recovery in the breadth and the market once we saw the number reaching that level. So according to this indicator, we can say that we have reached to the near term short term oversold levels. Now, last but not the least, is the Nifty positional trend. Nifty positional trend remains bearish. Nifty has been making lower tops and lower bottoms on the weekly charts, and Nifty medium term support seen at 14,366, which is nothing but the Fibonacci retracement on the long term chart. So here we have considered the entire swing from the March 2020 low to October 2021 highs. So overall trend remains bearish for the Nifty. Now let us conclude. Nifty has made doji candlestick pattern on the daily chart which indicates an indecision after downtrend. Low of 15,183 made on the doji candlestick pattern could act as an immediate support for the Nifty. RSI on the daily chart has reached oversold zone for both Nifty and Bank Nifty. Nifty small cap index has reached near to the downward sloping trendline support. RSI positive divergence is also observed on the Nifty small cap daily charts. Number of stocks above 200 DMA has reached very near to the oversold levels for the NSE 500 index. Considering the short-term chart developments, there are good chances that Nifty could show a pullback rally in the short term. Rally could push Nifty towards the previous breakdown levels of 15,700 to 15,750. However, positional trend of the Nifty is bearish with lower tops and lower bottoms on the weekly charts. Nifty is placed below its 20, 50, 100 and 200 days moving average, which indicates a bearish trend on the positional basis. Medium term support is placed at 14,366, which happens to be the 38.2% Fibonacci retracement of the entire upswing seen from the March 2020 low to October 2021 highs. Combining the short term and medium term chart developments, we believe that bearish markets can have a pullback, and same is expected out of the Nifty this time. Traders can wait for the Nifty to give pullback towards the 15,700. At 15,700, one can go short with a stop loss of 15,900 on closing basis in Nifty.
Thank you, Vinay. Now let's invite Nandish to share his views. Over to you, Nandish.
Good morning, friends. Welcome to this webinar. I am Nandish Shah, Technical and Derivative Analyst at HDFC Securities. I am going to discuss how the market is looking from the derivative side. So let's straight away jump to the presentation. As you can see here, we have seen long unwinding in the Nifty futures, where we have seen 0.02% fall in the open interest with Nifty falling by 5.61%. On the other end, we have seen short build-up in the Bank Nifty futures, where we have seen 4% rise in the open interest with Bank Nifty falling by 5%. However, on Friday, we have seen first sign of short covering in the Bank Nifty, where open interest has fallen by 9% with Bank Nifty rising by 0.4%. Now let's see what the option data is suggesting. Amongst the Nifty option for the 23rd June expiry, we have seen call writing at 15,700 to 15,800 levels. Therefore, on the higher side, 15,700 to 15,800 level to act as a strong resistance going forward. On the other hand, Nifty is likely to find an immediate support around 15,200 to 15,300 levels where we have seen put writing. So as you can see from the option distribution chart, we have seen put writing at 15,300 levels and also at 15,000 levels, while we have seen call writing at 15,700 to 15,800 levels. Now moving to FIs, during the week, FIs have created a fresh short where the net sold worth rupees 3247 crore with their open risk going up by 23,000 contracts, and therefore their net long to short ratio in the index futures has fallen to 0.16 levels from 0.26 levels on the 10th June. This is the lowest long to short ratio of FIs in the index future segment in the history of derivative markets. In other words, it indicates that out of total positions of FIs in the index future segment, 87% is in the short side while remaining 13% on the long side. However, on Friday, we have seen first sign of short covering by them as their long to short ratio has moved up to 0.16 levels from 0.13 levels. So as you can see from the slide, FI's long to short ratio was at 1.26 on 30th May and it fell sharply to 0.12 levels, and during this time Nifty has also fallen sharply, but now it has started rising and now it moved up to 0.16 levels. So it indicates that FIs have started covering their shorts and this may have a positive impact on the market. So as you can see in this chart, FI's long to short ratio was at 0.2 in the mid May. It moved up to 1.26 levels, and during that period Nifty also moved up. And from 30th May it fell sharply, and during that period Nifty also fell sharply. Now this ratio has started moving up, so it indicates that we may see some pullback really in the Nifty during the coming days. So just to conclude, as we discussed earlier, we have seen long unwinding in the Nifty futures, put writing at 15,000 to 15,300 levels, an oversold level of PCR, first sign of short covering by the FIs in the index future segment, and the fall of more than 1500 point during the last few days suggests that we may see some pullback rally in the markets. Therefore, our advice is that during that pullback rally, one should create short positions with the stop loss of 15,900 levels as primary trend for the Nifty remains negative. Coming to Bank Nifty, as we have seen first sign of short covering in the Bank Nifty futures on Friday, put trading at 32,000 to 32,500 levels, an oversold level of put call ratio, and also the sharp fall of more than 3,000 points during last few days. We expect some pullback really in the Bank Nifty too. If we were to see sharp pullback really in the Bank Nifty, and if it comes to around 33,400 levels, our advice is to create short around that level with stop loss of 34,000 levels. That is all from the derivative side.
Thank you, Nandish. Now let us discuss the way forward. We have released a note, Strategy and Picks in Volatile Times on June 16th. Please go through that. I will share the key highlights. So here we have identified some stocks and sectors which you can avoid and others you can accumulate. So we feel that some stocks could underperform over the next few quarters by falling more or rising less when the market starts to rise after making a bottom. Such stocks can be bucketed into three buckets. There are stocks which have good growth visibility but are expensive on the valuation fronts. They are from capital goods and IT, chemicals and cable sector. There are stocks which we think that they have seen the best of their days and may see some unwinding going forward. They are in metal and pharmaceuticals. And there are some stocks which are trading at a fairly steep valuation in face of uncertainty. They are mostly into FMCG, consumer staples. So we feel that the investors either should stay away from bottom fishing in these or exit them partly or fully on the rises. While if you are sitting on a cash and if you are looking to accumulate stocks, we have compiled a list of 14 stocks that can be accumulated over the next 3 to 6 months. We have bucketed them in two baskets, medium risk and high risk. You can start accumulating them. See, nobody can catch a bottom, hence, it is necessary to begin this process. To achieve an attractive entry point, it is important to average these stocks on the downside. What are these stocks? So here is the list of these stocks, 7 high risk stocks and 7 medium risk stocks. Detailed note on this is shared in our strategy note. I request all of you to go through them. Thank you friends for watching this video. I hope you find this video series useful. If you have any comments, share it with us by sending us an email or on WhatsApp group messages. Have a great weekend ahead. Thank you.